It's Wednesday, March 5th. I'm Logan Moody, and this is the Contrarian. The markets continue to panic on tariffs as oil crashes below $70 a barrel. GDP continues to slow, and overall skepticism remains high. So today I'll be touching on a lot of the prominent headlines of the week. I would say most importantly is that the stock market continues to just have a high degree of skepticism when it comes to the game of tariffs that are now being played. The stock market and the markets, generally speaking, have been very hesitant in the last weeks, especially when the tariffs on Canada and Mexico actually went into effect just yesterday. Of course, there were a few exceptions that were granted to automakers and a few other select industries, but by and large, the tariffs are still in place on Mexican and Canadian tariffs. We'll see how long that lasts. It may actually not last that long. Either the countries will kind of give in to Trump's, demands, or some kind of deal will likely be made. So, I only say that just due to the fact of how big of a market the United States is for Canadian and Mexican exports. It's their biggest market by far. So a deal kind of has to be made, and I would expect that to happen sooner rather than later. But oil is kind of an interesting market right now because oil has undergone a lot of volatility in the last 3 years. Of course, with Russia invading Ukraine in February of 2022, oil spiked to just over $130 a barrel. And then since then, it has kind of been in a consolidation, but definitely in a bear market since then. Oil just recently fell under the $70 a barrel level, and this has acted as some key support for the last year or more, where usually oil would get down to around the $70 a barrel level, and at that point it would kind of, bump, bump up from there. It kind of acted as a key support level, and with oil decisively breaking under the $60 a barrel level, it does, I would say, tie in with a lot of the economic slowdown type of trends that we are seeing across the board right now. And to really tie in with this well is the recent GDP Now update that is now indicating that GDP is at some negative 2.5% for the first quarter if it were measured today. And GDP Now is kind of an interesting metric because it essentially takes all of the available data today and tries to extrapolate what the current quarter would come out as in terms of GDP. And it's interesting because immediately after Trump's election and up until just a few weeks ago, it was actually showing a positive anywhere from 1.5 to, I would say, 3% target for the first quarter. So it was showing some very strong economic growth type of indication for the first quarter of 2025. And of course, all of that was spooking the markets with regards to being worried about higher inflation, returning inflation, and everything like that. Whereas in the last week, it has almost shifted 180 degrees the other direction because now GDP now has fallen to negative 2.5% for this first quarter. Now, first off, I would just say this is a huge swing to have in about a week. I would be surprised if it's undergone a swing like this before. I mean, maybe with the COVID shutdowns and everything like that, but this is just a huge swing for the current estimate of GDP to go from something like, positive 1.5% down to now negative 2.5, some 350 basis points or more. I mean, that is just a huge swing for the GDP Now indicator to undergo. Of course, I think the GDP Now indicator is taking into account a lot of things that probably will change between now and the end of March. It's likely that just with tariffs and kind of all of the economic uncertainty that comes with them, companies are likely just kind of sitting on their hands when it comes to either hiring more people or firing more people, or with any sort of, I would say, just corporate action that could potentially put them at risk or put them, give them some kind of unneeded leverage that they don't really want to have when there's this kind of uncertainty, just when it comes to tariffs and everything like that. So, bottom line, I don't think the first quarter GDP will actually be that much of a contraction, but it is really interesting to see just how quickly the narrative on Wall Street switched from being worried about, high inflation to now being worried about a recession or, risks of a recession. So that's really interesting to look at, as well as oil, because, I say that kind of goes hand in hand with oil falling. Is oil is almost a gauge of, upcoming economic expectations and how much people expect there to be demand for oil and, growth in the overall economy going forward. The oil market, of course, there's been a lot of regulations and things like that that have played into that as well, with regards to increasing the supply in oil. So that can definitely tie in with it too. But I would say oil and then GDP now kind of are going hand in hand when it comes to just the overall slowdown that is now being expected in the overall economy. So, where we are right now, I would say, is almost sentiment pretty much being reset from where it was with the immediate result of the election. I mean, the election caused a massive rally in the stock market. It caused a massive, not a massive, but a decent spike in the dollar and in interest rates. Since then, we've kind of seen almost a gradual decrease of these effects. So we've seen the stock market come off, pretty much erase all of its post-election gains. We've seen interest rates come down quite a bit in the last month. We've also seen the dollar come down a decent amount. So it's almost like sentiment and the overall effects of the election have kind of worn off at this point. And I would say just the overall sentiment has kind of been reset in terms of investors no longer being, I would say, extremely optimistic about growth in the economy going forward, which, if anything, this kind of, in my mind, sets up the market well for a nice upcoming rally. This could take the form of, for example, a trade deal being made with Canada and Mexico and tariffs going away. It could come on the back of some other sort of positive news like this, or, something like GDP, ticking back up or something like that. And of course, the Fed will now come into play, because if the Fed suddenly sees a slowing economy and more disinflation, so lower levels of inflation, suddenly they are going to have good reasons for monetary easing policies, or at least lowering rates more. And that will be very bullish for the markets as well. So I continue to expect the sort of bad news being good news kind of effect to continue when it comes to the markets. Just a few weeks ago, the markets were very concerned about higher levels of inflation and that interest rates would have to go back up or stay high for longer. And it really does appear that that whole narrative is beginning to fade away. We're just continuing to see a lot of, I would say, just hesitation in the part of the markets with regards to, just being overall hesitant right now with regards to their overall expectations. Because if anything, in the first 6 weeks of this new administration, I would say it's kind of shown that kind of the old playbook is by and large no longer really being used right now. By and large, I say, because in some ways it still is, but I would say in just some key ways it is not. For example, the kind of trade, or trade, the lack thereof of trade negotiation with trading partners with the United States has kind of gone out the window. It's kind of a situation of, a much higher level stakes game being played at this point, with regards to global trade between the US and our trading partners, and just overall relationships between other countries. I think the new administration kind of realizes that they don't maybe have the luxury of taking a lot of time with things. They likely only have 2 years to really get the things done that they want to get done. And if anything, they kind of realize that, with how in debt everything the United States is at this point, they likely don't have much time to really do what they want to do. And so the overall pace of everything has really picked up. I would just say a lot of things have occurred that, I might not have even expected, the whole inclusion of crypto or some kind of, strategic crypto fund, kind of little blips of this being dropped here and there. But, overall, really no hard facts surrounding that yet. So that is another thing that kind of continues to play along in the background. Perhaps it's more noise than any sort of reality, but we will really wait and see what happens with all of that, the crypto strategic fund or whatever that is. In my mind, that really doesn't make sense to do something like that, given the whole effect or the whole goal of what the government efficiency initiative is. And if they're trying to cut waste and fraud and abuse from the government spending, in my mind, it does not make sense to then go around and spend actual money on kind of things that have no intrinsic value whatsoever. So that will hopefully be something that doesn't actually happen, but we will really need to wait and see on that. Yeah, I have no idea if something like that would actually happen. Of course, the federal government does already have a lot of Bitcoin, so maybe it would just take the form of actually including it in some kind of, fund that the Federal Reserve had alongside their gold or something. I don't know. Nobody really knows on that. Of course, there is a lot of speculation going around with that in the whole crypto space. I will just say that it's some very interesting price action that happened in the crypto space after Trump kind of gave a few tweets on the crypto strategic fund or whatever they're calling it, because until then it wasn't really a thing, and then he tweeted about it, so it's kind of maybe there's a little more reality to it. But I would have thought that Bitcoin and everything would have spiked a lot more on that. If anything, there was a lot of selling that occurred right after that happened. So I'm not quite sure what happened there, but yeah, maybe we'll hear more about that in the coming days. So I'd love to know what all of you think about these topics in the comment section below. Of course, oil, I would say GDP Now, probably the most significant things of this week. Just the overall sentiment that we're seeing right now as well in the markets. Love to know what you think about all of these, and I hope to see all of you again at some point.